Hello, Edward Shek here from the ITPM. Good to see you all again. Today we're going to be rustling up some alpha. And the US election has thrown up a great new set of opportunities, and I've only got time to briefly go through one. And today I'm going to explain why I'm adding a mid-cap software name to the portfolio, adding a bit more mid-cap and hedging it for inflation risk. So my starting point today is to have a quick look at the relative performance of the major indices over 3 years and 3 months. So if you have a quick look at this chart, if you look at the historic chart of the main indices, that you'll see over the last 3 years, the Russell's gone nowhere. Mid-caps are flat, down a tickle, literally gone nowhere. And that makes sense. After all, until more recently, there have been lingering concerns about a recession. But more importantly, everyone's been too busy buying Nvidia and chips and data center and hardware stocks for the big AI build-out. And there has been room for a smattering of quality software names, ServiceNow, AppLovin, Palantir, but only those software names that had a viable best-in-class AI product available now. The vast majority of software names had nothing other than huge excitement about the opportunity, the usual. However, if we look at the same chart over the last 3 months covering earnings and the election, we can see that the leadership's changed. And now the Russell is at the top of the pile. Now there are 2 main reasons for this. First is quantitatively looking at earnings growth year over year for big caps versus mid caps and small caps. So if we think of big caps rather, they've just reported earnings of 5% year over year, 5.5%. Well, that's okay. I mean, it was 8.5% expected 6 months ago. It's come down to 5%. Q4's expecting 12%, and it was 17% 6 months ago. So the numbers at face value are fine. The rates have changed, not quite so good. But when you compare that to the mid-cap earnings growth expected for what's just reported in Q4, they're much higher. And more importantly, as everything is real rates of change within a frame of reference, they've gone nowhere for years, literally 3 years. So now we're starting to see earnings growth in the mid-caps. The rates of change are greater than that of the large caps. And of course, the second reason is Trump. I'll deal with the negative ramifications in a little bit. The market's certainly trading as if we're just pricing in all the positives. Pro-business, deregulation, personal tax cuts, corporate tax cuts. And now, of course, the data's better. Trump's won. So any lingering concerns about a recession may have abated and animal spirits return. And of course, looking at this chart, just a chart of the Russell, it's knocking on the door of a breakout. So that frames why I want to have more mid-cap exposure. Now, of course, I've got to think about what sector. Do I go for value? Do I go for growth? There's room for both, but I'm going to focus on today's pick, which is in the software sector. Now, I think at the end of February, I did a flash called How Do You Like Your Tech, Hard or Soft? And with Chris Quill's help, I compiled some indices, AI hardware, data center, hyperscalers, AI software, and the mid-cap software stocks. And if you look at this chart, the yellow line is the last time we showed this chart. And you can see those 2 red circles. So what I'm really betting on with this trade is there's more potential upside if I can pick a good mid-cap software stock now than there has been for a very long time. And we know Nvidia's reporting and maybe they beat, maybe the stock goes up, maybe it doesn't, maybe there's rotation, but there's more incremental evidence through market observation that suggests software is starting to perform a bit better. Remember the previous comment about not that many software companies did have an AI product over the last year. You look at stocks like CRM, that's rallying now, and they've just hired 1,000 people to sell their new Gen AI software. The CEO's very excited about this massive opportunity and the feedback's been great. HubSpot, this is in the CRM space. They're still putting in slightly better numbers, but the stocks are all rallying now. If you look at CRM, even Teams, even some of the smaller services or software stocks are all rallying through earnings. Not all of them, but a lot of them. And I've noticed that some of the rallies are probably bigger than you would expect from just looking at small beats. So you can see why I'm now looking at software. You understand why I'm looking at mid-caps. And so we'll come into Freshworks now. 4.8 billion, right in the mid-cap zone. And Freshworks is a global software company, suite of cloud-based tools. Freshdesk is customer support, all AI-powered bots like Freddy AI. Fresh Sales is their typical CRM business. Fresh Chat, live messaging and chat. Fresh Service is IT service management. So I'm not expecting this company to set the world on fire. I mean, it targets small to medium-sized businesses. And as I've said, we've been worrying about a recession up until quite recently. And now with market-friendly policies, maybe optimism returns. Maybe these companies start to find IT budgets start to increase in their space, maybe. And they compete with Zendesk, Salesforce, HubSpot, ServiceNow, very tough. But I think the target market's still pretty good, and they're operating at the smaller end, and I think they can grow. Well, that's what they do. They've got 69,000 customers, Sony, American Express, they've got some proper big clients. Why now? Every time I trade, why now? Well, I think market observations suggest this is a good factor. I understand that if money flows into these bombed out mid-caps, it won't just flow because of boredom. There must be a reason. They've just reported Q3 2024, sales beat, earnings beat, guiding up. Well, that's great. And when we look at forward numbers, the opportunity, I think, is revenue growth is only 14% for this stock for the next 2 years. That's low. But I like the operational leverage that's baked into the numbers. This is current consensus, which I think is wrong. Operational leverage is when earnings per share growth is growing much faster than revenue growth, and they're putting in 33 and 24% expected. So it's leveraging slightly now. But the biggest opportunity for me, when you look through their earnings call, yeah, they've got no debt. Well, that will help if inflation gets a bit hotter, but it's not really going to stop tech selling off if rates move. I said they had 69,000 customers. Their new customer growth has just come in at 800. It's tiny. And the 800 is the best for a year. Well, it's not a surprise when you think about it. They've had nothing new to sell. Everyone's, companies are worrying about how they're going to integrate AI, hardware issues. Then they've got to see which vendors have actually got something they might use. They're taking their time. But now there's a lot of product coming into the market. Clearly, this is a probable outcome scenario where they're going to get their fair share and hopefully more. But their new customer growth is just starting to accelerate, which makes sense. That's why when they report next February, I think there's a good chance of a beat. And remember, the stock is only trading on 5 times sales and it's been beaten up. It's an extraordinary market when you think the main indices are at or very near all-time highs. Markets got reasons to broaden out. But the high-fliers are still driving it. There are so many good stocks that have literally gone nowhere over 3 years. You got to find the ones that have got the best chance of beating low expectations, low valuations. These are stocks that have got a better chance, arguably, of going up 30 or 40% than Nvidia. But I'm not saying don't be long Nvidia. Anecdotally, Alphabet, they've cut their shares stake in Snowflake by 80%, increased Freshworks by 30%. I mean, not a major catalyst, but it helps. And then we come to the structure. So next earnings are Feb the 4th. The stock's just under 16. It's rallied off a low of 11 through the last earnings print, which 11 was the low it's been since coming out of lockdown. The 17.5-20 vertical call spread out to February to get the next earnings print. You can buy 100 contract spread for $5,000. You're buying the 17.5s at 85 cents, selling the 20s at 35. You're in the spread for 50 cents. The most it can be worth is $2.50. You're going to get a 4-to-1 return. Spend 5, make 20 if the stock's 20 or higher. So that's the long side. Now, inflation hedge. I want to get long inflation hedges now. Clearly, at the moment, geopolitics aside, the biggest risk to all the markets is a reacceleration of inflation. You look at the core PCE, it was 0.1 in May. It's ticked up to 0.2, last print 0.3. Nothing to scare anyone now, but you've got to remember Trump's policies clearly haven't been enacted yet. He's got a very strong mandate, as we all know, to get stuff done. But the inflation problem's going to be a Q1, Q2 problem eventually. And of course, talk is cheap. Tariff talk is very cheap. We don't know what will happen. But if inflation's not coming back now, and there's some uncomfortable signs of reacceleration in some of the segments, you've got to have some inflation protection. Whatever your bias, whatever, your absolute view, it doesn't make any sense not to have inflation protection. So the obvious instrument is TLT, the 20-year bond future, currently trading at about 90. Again, I could do a longer dated vertical, a vertical put spread 88 to 82. You'll be paying $2.28 for the March 88 puts, getting 81 cents back for the 82 puts. Have 34 spreads for your $5,000. And if this instrument gets down to 82, near the previous lows when we still weren't sure if rates were going up, you'll get a 3-for-1. More aggressive structure going out of the money, you'll get that up to 4 or 5. I just wanted to say one other thing about inflation hedges. Obviously, some people prefer gold, but that's not for me for an inflation hedge. You could even look at something like a DR Horton, DHI. Now, I know this is a mid-cap. Well, all the home builders are mid-cap. But it's had on a premium valuation compared to the peers. They've recently reported a miss in revenue, miss in earnings, and that's when mortgage rates had fallen through the quarter steadily and quite fast down to 6.2. Well, that hasn't spurred a big reacceleration in good demand, good pricing in their target market at sort of starter, $400,000 level homes. And now mortgage rates are back above 7 and rising, and Trump's policies are yet to come. So I think, there are many ways to express inflation protection, but you've got to have a couple of positions that are going to do well if inflation accelerates over the next 2 to 4 months. So that's the ITPM Flash, the final one from me this year. I hope you've had a great year. Have a good last month into the holidays. Buying Freshworks, buying inflation protection. Happy holidays. Look forward to seeing you in the new year. Bye-bye.